Central banks and regulators raced to reassure markets and customers Monday after one of the world's largest banks exited the global stage in a forced takeover. The details of the $3.2 billion deal for Credit Suisse rattled some investors, but regulators have sought to make one thing clear. The focus is on depositors and the health of the overall banking system.
Switzerland's government says it was left with very few choices. And so it said supporting Swiss global banking giant UBS's takeover of rival Credit Suisse was the best option to avoid a financial crisis.
The bankruptcy of a global systematically important bank would have caused irreparable economic turmoil in Switzerland and throughout the world. For this reason, Switzerland had to take the responsibilities beyond its own borders.
The Swiss central bank has agreed to offer a $100 billion loan, and the government will guarantee up to $9 billion of potential losses should UBS's losses from the takeover exceed a certain threshold.
It means we bring back stability and security for Credit Suisse clients. That is very important. And also we keep the reputation of Switzerland as a financial center high. And finally, it means that we are stemming the turmoil in the international financial markets. These are the three goals that are very, very important to us.
Credit Suisse's balance sheet is around double the size of Lehman Brothers, which triggered the 2008 financial crisis when it collapsed. The Swiss bank is far more embedded in the global financial system, with multiple international subsidiaries. The Swiss government says a Credit Suisse collapse could have triggered a financial crisis. And that's why they stepped in to support its rescue by UBS, a move supported by experts.
Once a large and highly connected institution such as this runs into trouble, there's always a risk of contagion, and it may be a good idea for regulators and central bankers to try to get ahead of that problem.
Swiss financial authorities have the support of their peers. The U.S. Federal Reserve, the ECB, and other major central banks have released statements welcoming the rescue of Credit Suisse.
Friedrich Heidemann can talk us through this. He's an expert on international financial systems at the Leibniz Center for European Economic Research in Mannheim. Welcome to DW. So we have Switzerland's biggest bank taking over the country's second biggest bank. Just explain to us how big a deal that is.
Yeah, that's quite a substantial deal. I mean, both banks belong to the 30 globally important banks that are deemed to be of systemic relevance. So one of these big ones, the UBS, has a balance sheet of 1 trillion. It's taking over the Credit Suisse with a balance sheet of about half the size. So together it's going to be one very substantive large player. And I think it's meant to be a strong sign of building trust now that the Swiss authorities are able to act and to stabilize the situation in a critical moment.
OK, so we have two banks in the US which go down and cause this problem in Switzerland. Central banks now are scrambling to calm fears that this could ripple around the world. Is that risk now contained?
No, it's not perfectly contained, but I think what you really notice is that authorities have learned from the great financial crisis in 2008, 2009. So they are acting much faster than they did in the past. They're acting strongly, and this is sending out signs of trust building. And one should also recognize that fundamentals are much stronger today than they were in 2009. Capital is higher in the banks. Regulation is stronger and tighter. It was disappointing that the Silicon Valley Bank collapsed, and this was a big disappointment because everybody expected, well, we have learned so much, regulation is so tight, and now we have to learn, well, they had pretty traditional mistakes in their balance sheets. This was a big disappointment. That's why now people are so are now lacking trust. They're looking at weak banks. They're asking, well, is the business model really viable? And that's a problem right now.
So that's a little bit scary because you've said that they should have learned but didn't and still made fundamental mistakes. So I suppose my biggest question is, my money's not in a Swiss bank, it's not in a US bank, it's in a bank here in Germany. Is my money likely to be safe now?
Yes, sir. I mean, banks in a country like Germany, they are, of course, under stress from this increase in interest rates, but they also benefit from it because they earn money from the normal business of taking in money in their accounts and lending it out. And this has become profitable again because of the increase in interest rate. So the increase in interest rate is a curse and a blessing. And I think for many banks, the net effect is quite positive. So that's why I'm not too pessimistic. The big issue is really the European real estate market. So as long as the real estate market stays stable, I'm quite confident that we will not see a big banking crisis in Europe.
OK, that's a good note to leave it on. Thank you so much for talking us through that. Friedrich Heinemann from the Leibniz Center for European Economic Research. Thank you.
It was a pleasure. Thanks.
Carsten Junius is chief economist at J. Safra Sarasin. That's a private Swiss bank. Carsten, welcome to the show. We've seen already that markets are having a little indigestion with this deal. When we look at the global banking system, will this deal do more good than harm?
So it's always the question of what the alternatives would have been. So nationalization is probably not better. Bankruptcy wouldn't be better. It's in the end probably the least bad solution that we could get in this situation, as surprising as it was for all of us. The question now is what do we do with such a big bank within Switzerland, not a too large country, and how this is impacting financing conditions for other banks. As one thing is clear, a lot of shareholders have been are facing a lot of losses, a lot of bondholders are facing losses, and this in the end could increase borrowing costs for banks all over the world.
I'd like you to listen to a clip that we have. This is Pascal Donahue. He's head of the Eurogroup. That's the gathering of Eurozone finance ministers. We asked him just on Friday if Europe's banks were fundamentally healthy, and here's what he said. Take a listen.
Yes, I believe they are in the context of the changes that are taking place at the moment. We can see changes that are taking place elsewhere in the world. We're aware of the development with regard to a European bank that has taken place this week. But if I look at where we are overall, I believe the regulatory changes that we have made since the global financial crisis have had a very significant and positive effect on our banking system. I also look at the amount of capital and liquidity that our banks have at the moment. And again, I believe that is a very strong level of protection against the kind of risks that have developed. So we can never be complacent, but I do believe the measures that we have taken will work.
All right, that was Eurogroup head Pascal Donahue speaking with my colleague Rob Watts there. Back to you, Carsten Junius. Is that true? Are European banks fundamentally in a much better position to handle what we're seeing right now when we look at capital, when we look at some of the leveraging changes that have been made, all of that taken together?
So I also believe that we are in a better situation, that regulation is much better, that the banking sector is in a much better situation. But what we heard in this short clip was a couple of times, I believe. So there is no absolute sense in that. It's a confidence issue that we have, and confidence can be gained and can be lost, and it can be gone within a very short period of time. That means we have multiple equilibria in this situation, and I only can say I also hope and I believe that confidence is coming back and that we don't have contagion effects. But 100% sure we can never be in such an issue.
Carsten, Swiss bankers are supposed to be prudent and rather boring. What is this deal that we've just seen, this kind of urgent situation? What does it mean for your country's reputation as a banking destination?
Well, it's definitely not helpful, but we should be aware there are always well-run banks and not so well-run banks. That is, I think, even clear if you look at the two big ones. UBS making huge gains last year, Credit Suisse not so. So it always depends on the circumstances on each individual company.
All right, that's Carsten Junius at J. Safra Sarasin. That's a private Swiss bank. Thank you very much.
Thank you.